All right. Well, hello, everyone. Thanks for joining us today. My name is Jake Duvall. I'm the Business Development Officer for Lane Gorman Trubit here in Houston. And I first want to say thanks for joining us today. Be sure to check the chat for more information about LGT and how to follow up with today's webinar. And if you have questions during the presentation, please feel free to submit them to the Q&A section, and we'll touch on them at the end. The Dallas and Houston commercial real estate markets are shifting fast, and rate cuts are stirring the pot. If you're looking to understand how these changes could impact your business, you're in the right place. With that, I'm excited to introduce our speakers for today. First, we have Ching-Ting Wong, who's the Regional Director of Texas and Southeast Research for Dallas of Newmark. Second, we have Kirsten Kempf. Kirsten serves as the Senior Research Analyst in Newmark's Houston office. Next, we have John Tagg, who's the Senior Research Analyst up in Dallas. And then finally, Joe Biasi, who's the Head of Commercial Capital Markets of Research in Boston. And with that, Joe, I'll kick it off to you to start the presentation.
Thanks, Jake. Yeah, so I'm just going to give a brief overview of capital markets and what that looks like, because it's at a national level, but it filters back down, certainly into the Dallas and Houston areas. So if we just go to the next slide, we had a rate cut last week. We had an election last week. Rates are moving everywhere, mainly up, frankly. The 10-year Treasury is up roughly 70 basis points from where it was in September when we got that big 50 basis point rate cut. Now, where rates head in the future, I would say it's difficult to predict. We are seeing longer-term rates move up, and that indicates that maybe we're not getting as many rate cuts as we would have liked a couple of months ago or thought a couple of months ago. But at the end of the day, the expectation of really stronger economic growth, certainly a benefit to growth markets, to commercial real estate, but it's causing some higher rates are causing some problems in commercial real estate, particularly when we think about how that factors into rents, occupancy, and the availability of commercial real estate capital. So if we move to the next slide, when rates began to move up in 2022, we saw lenders really begin to pull back on commercial real estate lending. We had $819 billion of commercial real estate origination volume in 2022 and $507 billion in 2023, and we're really on pace for about the same in 2024. What's happening is not only are lenders and commercial real estate debt providers, not only are they facing kind of the same issues with slowing down financial markets, they're also a lot of their loans are tied up in current loans. Most commercial real estate lenders are engaging in some form of extend and pretend. They're basically they're allowing borrowers who can't pay off the loan at the balloon payment at the end of their maturity, and they're allowing them to continue that loan. But that ties up capital. And that's really slowed down transaction markets. That's really slowed down capital markets. It's tying up a lot of lenders' capital. We've begun to see an uptick in lending in the last quarter, in the last couple of months in particular, though even that is beginning to wane. The reason we saw that uptick in capital was that interest rates were really low in September. The 10-year Treasury yield was 3.6%. Today, it's at 4.3%, and what we're hearing from lenders is they're beginning to back off a little bit again. The numbers that or the deals that pencil out at 3.6 don't pencil out at 4.3. And this is causing a lot of stress in the commercial real estate market, particularly when it comes to office. I want to move to the next slide. So office origination volume is roughly half of what we saw before the pandemic. It's roughly half of what we saw in 2022 and 2021. And this really matters even on a local level, because landlords not only are just trying to meet market rents, but oftentimes landlords have debt on buildings. So they're often 50, 60% leveraged on these buildings, and they have debt covenants that they need to follow. It makes it very difficult for them to cut their asking rents. So we haven't actually seen significant, and this is nationally, we haven't seen significant rent declines for asking rents, though concessions are certainly popping up. And a big reason for that is the landlords literally can't do that. They literally have, certain debt service coverage covenants that they need to meet in order to service that debt, and it's causing some issues. We expect to see more distress in the future, particularly in office, maybe a little bit in multifamily as well. That's less relevant for today. On the other side, industrial, we've seen a significant uptick even today in originations. It's much higher than it was in 2017 to 2019. Though lenders are backing off a little bit, the thought behind originations in industrial is that it's still a well-performing asset. If you go to the next side, where lenders are pulling back, it's mostly banks that are pulling back lending and replacing it with CMBS, and financial just means debt funds, and that's private lenders. Lenders who specifically raise capital, non-bank actors who raise capital to provide commercial real estate debt. So why is that important? Going forward, a lot of those lenders charge much higher interest rates. They tend to be shorter term loans, and they're a lot more expensive for borrowers. That's going to matter down the line as we continue to churn loans into a higher interest rate environment, which, if we look at the next slide, is going to be a problem for the foreseeable future. So let's take a scenario that seems the most likely today, which is that interest rates without a recession remain much higher than they did pre-pandemic, right? So we're looking at the BBB bond yield. So at barely investment grade bond, we look at that when we try to compare it to commercial real estate. And then we're looking at the interest rate of maturing debt over time. And for a very long time, borrowers, commercial real estate, benefited from having lower interest. Their loans were maturing into lower interest rate environments. That has obviously changed in the last couple of years, and we expect that to continue to be the case at least through the rest of this decade, where commercial real estate loans that were originated 10 years ago, with Fed funds rate at 0% and a 10-year yield at 3% and a BBB yield at 4%. Now all of a sudden they're looking at a Fed funds rate of 4.5%. They're looking at a BBB yield of roughly 5.5%. And that means that their debt costs are going to go up, which puts a little bit of a floor on the rents that they're able to offer across the board. This is nationally. This is not only Dallas. It's not only Houston. It's across the board. And so I just want to finish with on the last slide here a quick update on pricing for commercial real estate, which is that if you look at at bond yields and compare it to cap rates, which is essentially yield of commercial real estate. So if you look at the income over the value of commercial real estate, you get a cap rate. You compare that to a bond yield, you get a spread, and that spread tells us how relatively expensive or cheap commercial real estate is. And for a lot of commercial real estate, because interest rates are so high compared to where they've been historically, commercial real estate values are still catching up. And if we take office out of the equation for a second and look just at industrial, industrial still looks really expensive. Additionally, there was a Prologis just released its report on its national industrial portfolio, and they mentioned that their replacement cost, so the cost to construct new industrial, the rents that they would need to achieve to make that worth it to build that industrial is 15% higher than current market rents. So industrial looks really expensive, which is good for development, bad for buying, but the rental markets are not keeping up with the construction costs. On the other side, office looks very cheap, but there's a reason that it looks very cheap. There's a lot of risk perceived in office, and it's really difficult to pull apart what's good and what's bad. Luckily, I have Kirsten and John who can tell you for Dallas and Houston and have a much better idea for specific markets. But at the end of the day, the office market is expected to continue to go through this long period of rationalization, of distress, and working through the existing debt on those buildings. Remember, commercial real estate debt often has balloon payments at the end of those loans. So if you have a 10-year loan, it's on a 30-year amortization. And if your values have declined, like most office values have declined, it's very difficult to churn that debt. And a lot of these landlords are kind of locked into these buildings and are either going to have to sell at a loss and put up capital to make up the rest of that loan, or they're going to flip the keys back to their lenders. It makes it very difficult to to adjust your performance metrics, to adjust your rental rates when you have to service this debt that was originated in a completely different interest rate, a completely different lending environment. So with that, I'm going to kick it over to John for the Dallas-Fort Worth market overview.
Thanks for having me. My name is John Tagg. I'm with the Dallas research team, and I cover the Southeast in addition to Dallas. So we'll cover Dallas here's office first, but first thing I want to point out a couple rankings here. ULI's emerging trends in real estate just updated. We moved from number 3 to number 1 for overall real estate prospects. And Site Selection magazine just put out another ranking. We achieved the number 1 business climate rank yet again this year. Next slide. So looking at some of the fundamentals that make up Dallas-Fort Worth, as you can see, our cost of living is about middle of the pack with other major metros, but our cost of business is actually very favorable compared to most others as well. Our population growth in the last 5 years and our projected population growth continue to outperform most other markets. And our employment growth, of course, far exceeds every other major metro, and we have a very healthy industry diversity index. Next slide. Next one. So looking at our overall office using employment, we do remain at near an all-time high, and our unemployment rate across all industries remains fairly level around 3.8%. Some of the contraction in the business and professional sector in the last 12 months has been one contributing factor to the uptick that we've seen in unemployment. But again, other office using sectors such as financial services have actually seen growth to the tune of about 3% year over year. Next slide. So this is kind of looking at the overall picture as far as deliveries, absorption, and vacancy. As you can see, we're kind of trending above that long-term 20-year vacancy, which is just around 19%. We're up near 25% now, but this vacancy has actually started to level off in the last 2 quarters. Of course, vacancy has risen through the pandemic and through the continued delivery of new product to market. However, we do anticipate that this will eventually level off into 2025. As far as positive absorption goes there, we do have a number of build-to-suit projects that are kind of keeping us buoyant as far as net absorption goes year to date. But as far as the remainder of the year goes, we don't see that many others finishing up. Next slide. As far as overall construction activity, this has continued to decline since 2018. And as far as the number of projects that remain in the pipeline yet, many of those are actually medical office use or build-to-suit projects. So those won't really even be spaces or rather space that can be taken by tenants that are looking for space in the market. So actually, this is kind of shrinking up substantially compared to the last 10 years. Next slide. Our year-to-date leasing activity, as you can see, is at our lowest point since 2009. What we project through the end of 2024 is somewhat similar to 2020, 21, and 23. And of course, you can see there are 16-year annual leasing average around 19 million square feet. Next slide. So as Joe said, of course, the rents are going to remain elevated. As you can see here, we're easing slightly from our all-time high that we achieved at the end of 2023, but we are still seeing growth year over year of around 1%. And as you can see on the right-hand side here, that rental growth rate is tapering off, and we are anticipating that to kind of flatline or at least plateau into 2025. Next slide. Looking at the difference between Class A and B assets, you can see this bifurcation has continued to increase since 2019. We're tracking around a 22.5% spread increase since then. As tenants continue, of course, this flight to quality, whether they're right sizing or downsizing or even expanding, they continue to choose higher quality assets, which do continue to prefer higher asking rents. Sublease rates have actually been somewhat steady with a recent downtick in the last quarter, and they currently reside around $26.50 per square foot. Next slide. Going on to the industrial market. Our industrial sectors are at all-time high employment, and actually trade, transportation, and utilities is Dallas's largest employment sector. Thankfully, we still continue to see growth in that area with a recent uptick. And manufacturing, on the other hand, also at all-time highs, has seen tremendous growth recently in the last few quarters. Next slide. So looking at kind of the overall picture for absorption and deliveries versus vacancy in our market, you can see we kind of hit a low point in 2021 of around 5% vacancy. And even leading up to that, you can kind of see absorption and deliveries were kind of in lockstep leading up to that point. When we hit the pandemic, there was a rush to develop a lot of new product. You can see 2023 was a record-breaking year for deliveries, and that in turn, with reducing demand or decreasing demand, has given rise to this vacancy rate today of 9.5%. It'll just take some more time to absorb that. Next slide. Our pipeline hit an all-time high. Construction projects in progress, 76 million square feet towards the end of 22, but that's been declining ever since. And actually, we're kind of back down to where we figure is probably close to a baseline. This is essentially going to plateau for at least the next quarter or so until we start to see an uptick once again. Next slide. Leasing, similar to office, although not at 2009 lows, industrial leasing is around 2010 lows, although still quite positive and still outperforming many other markets as far as demand. We do expect this to be kind of in the same trend through the end of this year and into the first and second quarters of next year. Next slide. And like office, of course, with all of this delivery of new space, and with the other constraints in place, asking rents have also increased. Although the asking rent growth has still been quite high with the delivery of all of this new product. We do, however, anticipate that into next year and through next year, this growth rate will continue to flatten. And with that, I turn it over to Kirsten Kempf in our Houston office. Thanks.
Good afternoon. I'm Kirsten Kempf, Senior Research Analyst for Newmark Southeast Region. Today I'll be discussing the Houston office and industrial markets. To get started, let's take a quick look at the economic fundamentals in Houston. Houston typically performs quite well in these fundamentals, specifically population growth and the cost of doing business. Houston consistently ranks in the top 5 markets for lowest cost of doing business. And in the last 5 years, Houston's population has grown by about 500,000 people, second only to Dallas-Fort Worth amongst the major metros. And we're expected to see additional growth of about 640,000 people through 2030. Next slide. Regarding Houston's annual rankings among notable publications, I'd like to call out that we recently moved up the ranks to number 3 in the ULI Emerging Trends in Real Estate report for overall real estate prospects. It's the first time in about a decade that we've cracked the top 10, so that's quite an important metric. And also a major economic driver in the region is Port Houston, which ranks as the 5th top U.S. container port by total TEUs, which are 20-foot equivalent units. And Port Houston handles about 73% of container traffic on the U.S. Gulf Coast. Next slide. So heading into the Houston office market, Houston's current unemployment rate is currently about 4.4%, and that generally mirrors the national unemployment trend rate. Houston's office using employment has been steadily trending upwards since the pandemic and currently exceeds pre-pandemic levels and recently hit an all-time high in April of this year. Next slide. Regarding Houston's office market fundamentals, Houston's office vacancy has been steadily increasing since the oil downturn in 2015, 2016, and heavy construction deliveries that occurred in 2015 helped to kind of really accelerate the market's increase in vacancy, which then continued throughout the pandemic years with, coupled with negative absorption in that same period, as you can see. Currently, the market has a vacancy rate of 25.2%. Next slide, please. So leasing activity in Houston's office market has a long-term annual average of 17.5 million square feet. In year-to-date 2024, we're seeing leasing activity totals of about 8.5 million square feet. So we're likely going to close the year well below that long-term average. Additionally, deal volume fell by about 18.7% year over year, which we're attributing to occupiers waiting out the financing environment, and then additionally the recent November election cycle before they make some of these big decisions. Next slide, please. So one of the main trends that's currently occurring in Houston's office market I want to point out is the flight to quality. That tends to be a main trend here as occupiers are favoring new, higher quality assets. This slide in particular illustrates the CBD Central Business District office occupancy story. New amenity-rich product in that submarket is gaining market share in terms of occupancy rate, which you can see here. The Class A space currently commands the market with 86.4% of occupancy. So that has shifted over time. Next slide, please. Rental rates for Houston office product have been increasing in recent years and currently stand at $30.05 per square foot, which is a drop from the peak in the fourth quarter of 2023. And while rental rates remain elevated, rent growth has slowed year over year. In 2024, annually, it is negative 1.3%. Next slide. So kind of going on that trend of flight to quality, what you can see here on the left-hand side, that chart is the gap between Class A and Class B rental rates. It remains wide at $12.84 per square foot. And as the flight to quality trend persists, this rent spread between those two asset classes is likely to continue. And additionally, sublease rents dropped in the third quarter, leading the rent spread between direct and sublet rates to grow by 27.8% quarter over quarter. Next slide, please. Okay, so moving into the Houston industrial market, what you'll see here is that Houston employment or industrial employment in Houston, industrial employment continues to grow with trade, transportation, and utilities employment reaching a new all-time high in August 2024. We kind of keep just breaking our own record. Manufacturing employment has also been doing quite well. It grew at a faster pace than trade, transportation, and utilities, increasing about 2.2% year over year. Next slide. And regarding general market fundamentals for Houston industrial, in 2023, over 36.6 million square feet of new industrial supply delivered in the market, leading vacancy rates to climb. And while that supply continues to outpace demand year to date in 2024, the gap is closing. And as the construction pipeline levels out further, we'll see those vacancy rates start to stabilize along with demand. Next slide. Industrial leasing activity fell 17% year over year in the third quarter and totaled 8.7 million square feet, which is well below the third quarter average of 10.6 million square feet that we've been seeing. Next slide. Another just kind of interesting trend I wanted to point out is that Houston industrial sublease availability has been exceedingly high since the start of 2023, and there's a couple different factors for that. But at the beginning of this year, 2024, sublease availability in the market reached 7 million square feet. That's partially due to a couple of different large sublease blocks on the market, including Wayfair space that was 1.2 million square feet. It was started as a build-to-suit, and they never decided to occupy. So that space, along with two other deals, have taken nearly 2.2 million square feet of sublease space off the market this year alone. So we're expecting that to drop in the coming quarters as well. Next slide. And then to close out Houston industrial, we'll talk about rental rates just for a minute. So new supply in the market, as you saw in 2023, really helped to not just drive up vacancy, but also rental rates as well. So new supply is leading those rental rates to increase across industrial product across the market. Rates hit a new high of $9.45 per square foot in the third quarter of 2024, but the rate of growth is expected to slow as the market works through that construction pipeline. So that's it for Houston Industrial. And with that, let's move over to Ching Ting for what to expect going forward.
Thank you, Kirsten. Hello, all. This is Ching Ting Wong. I'll be going over the future and focus section. So I know a lot of people want to know what's going to happen next through the end of this year, as well as next year into 2025. So we've kind of split things out between Dallas as well as Houston. So we're going to jump into Dallas first. On the Dallas office front, a lot of the demand, of course, is driven by employment and labor. So on the left-hand side for office using employment, we are forecasting that employment is going to continue increasing over the next 5 years. The good news for that is that it's going to help us drive demand for office. So in terms of net absorption in the market, it's going to be negative still next year, similar to this year, but it's going to be a little bit less negative. Supply in terms of deliveries is going to decline next year, but there's still going to be a robust supply coming on the market. As a result, what's going to happen next is that vacancies are projected to flatten, and on the flip side, rents are going to increase just a bit through the end of next year. On the industrial front, labor again is going to drive the market forth. Trade, transportation, and utilities, as well as manufacturing employment, is projected to increase through the end of 2028. On the other side, that's going to drive demand in the market because we've actually come off very strong supply from 2023, and we've also worked through our pipeline from what John had showed earlier today. And so with that strong supply last year as well as this year, we're actually projecting that it's going to flip just a smidge next year, where you have demand slightly outpacing supply through the end of 2025. As a result of that, we're going to see vacancies flatten and rents increase just a little bit through the end of next year. Moving on to the Houston side, similar to the Dallas side for the office front, Houston is projected to continue growing in office using employment. Similar to Dallas as well, Houston's going to continue seeing negative absorption through the end of next year, but a bit at a smaller negative. So demand's going to be a little bit more positive next year compared to this year, but still remain negative. On the flip side, vacancies are going to flatten and rents are going to increase in Houston. For Houston industrial, similar to Dallas industrial, trade, transportation, utilities, as well as manufacturing employment is projected to increase through the end of 2028. As a result, on the flip side, for the demand side, we're going to see demand continue to remain positive in Houston industrial side of things, but it's actually going to be closer to the supply side through the end of next year. And as a result, you're going to see vacancies flatten in Houston industrial and rents increase just a smidge through the end of 2025. So bracing for the future, what are some things that we want to know about looking forward through the end of this year as well as into next year? One thing that I would suggest really looking and tapping into is resources for either technology and data. Data will be playing a huge role in helping us drive decisions going forward, and technology will help us visualize the information that we gather to see what's going to happen next. So I actually wanted to leave you guys with a simple case study that we had done previously. So I'm going to flip my screen just a bit here, just so we can see it. So we actually had a client that approached us. It's an office client. They were trying to figure out what they wanted to do with their office space. So they had two buildings that they were both occupying that were in close proximity to each other. And they wanted to see, hey, how do these two buildings compare? So in the technology side, we looked at what office using employment is, or what occupancy is within their two buildings. So a technology familiar to most people is your cell phone. So we looked at cell phone pings for people that are working in that area who also come and go within those buildings. And we're able to figure out what the visit trends are for both of these buildings and how the trends have looked since COVID. The other side of the story is that we're able to look at when people are occupying the building. So are they coming in Monday, Tuesdays, and Wednesdays more, or Tuesdays, Thursdays, and Fridays? And as you see, they tend to come in more in midweek into both of these buildings. One thing that was interesting for both of these buildings was that for one building, you see that people started leaving in the afternoon and it started declining in terms of how many people are in the building. Whereas in the other building, it kind of stayed fairly level until it was the end of the day. So that was an interesting trend that we were able to point out to our client on their office occupancy for both of their buildings using the technology that we have on hand. And as a result, we were able to show them that not only that, but we were able to figure out what places these big people or workers are doing before they go to the building and where they're going after the building. And one thing that we realized is they're spending a lot of time going back and forth between both of these buildings. So what ended up happening was we were able to calculate how much time people were spending, whether they decide to drive from one building to another, or whether they are walking from one building to another. And when we take, like, say, the average salary that they're paying on a high and low basis, and also how many trips they're taking from the technology that we had for their cell phone pings, we're able to figure out that there's money to be saved in terms of what can be done in terms of their office occupancy. So they're actually paying people to commute back and forth. So that was one example that I wanted to show everyone in terms of utilizing data as well as utilizing technology to figure out what to do best with your space. With that said, I'm going to leave you guys with our contact information for the presentation side. Our brokers, Scott Hobbs, as well as Kim Colvin-Lyon, are excellent to work with, and there'll definitely be a huge resource to tap into should you guys look at what you want to do next. We also have the list of speakers that we have with Joe Biasi on the capital market side, John Tagg on the Dallas market, Kirsten Kemp on the Houston market side, and then me on the future and focus side. So you have all of our contact information should you have further need in helping you decide on what to do next as you look through the end of this year, as well as debrace for the future. With that said, we're going to flip to back to Jake Duval, and then we'll enter into our fireside chat portion of our webinar today.
Thanks, Ching-Ting, and thanks everybody for a ton of really rich information. A few insights of mine that I kind of pulled out of that is Texas is the greatest market in the country. We've got number 1 and number 3 in places to do business, which is just incredible. Population growth is on the rise. Buildings are being built. So just a great day to live and work in Texas, if I pulled anything out of that presentation. But a lot of the conversation that we had kind of prior to this webinar was, and I think what most people are interested in, is how can we take all of those insights and apply it to decision-making in the future for our businesses, whether you're a small to medium-sized manufacturer or an business that has office employees that you might be requiring them to go back to work. How can you make the best decision given all the data that y'all just laid out? So the format of this chat for everybody here is very casual, question asking. I just kind of want to dig into some of those insights. So with that, I'm going to kind of walk through a little bit about the capital markets, Joe, that you touched on. And something that was really kind of stuck out to me was a lot about the short-term rate cuts not translating into long-term rate declines. How do you think that's going to factor into the expectations moving forward in commercial real estate?
Yeah, so I think when we got short-term rate cut, or when the Fed said, "Hey, we're going to cut rates," everybody got very excited. You could feel it in the market. You could see it happening. A lot of lenders poked their heads up. A lot of borrowers poked their heads up. But since then, we've gotten really strong economic data. We had a presidential election. And what we've seen is that at some point, short-term rates have to be lower than long-term rates. Over the last 2 years, that hasn't been true. What the market has been expecting with, like 6, 7, 8 rate cuts and getting this soft landing has never happened before, right? We've never had a soft landing with 200 basis points of rate cuts, 2 percentage points worth of rate cuts. And so if we get a few, let's say the Fed cuts again, and maybe cuts 2 or 3 more times in 2025, what that would suggest is that longer term yields, your 5 to 10-year treasuries, your corporate bond yields, and therefore the value of commercial real estate all has to adjust to kind of that new paradigm. And what that means is higher interest rates on the long term and lower values for commercial real estate.
So what's that going to do? Let's say I'm a business owner who's looking to start leasing in some of those buildings. If I'm a lender who's eyeing, maybe increased interest rates, and I'm a building owner who's having to meet debt covenants, what's that going to mean long term for my rates, and how can I action on some of that right now?
Yeah, so I mean, look, there, and you can. I know John and Kirsten can talk or speak more towards like the specific market trends within there, but overall, we've had for the first time in a very long time, particularly in office, we've had occupiers, we've had lessors looking at the financial stability of the landlords, completely turning around kind of the paradigm on them. There's really high demand for these really high quality new spaces, but that means that there's probably better deals and concessions happening in that second tier of space. What it means for the market overall, and what's to be concerned about is you might have more blight, you might have more churn. You need to understand who you're going into business with when you do these leases, because it is very possible in a lot of these office buildings that, particularly institutionally owned, where they feel a lot more comfortable flipping the keys back, the person you did a deal with might not be the person you're renewing with down the line. As we see office buildings begin to churn faster.
And you mentioned the lenders, and I want to come back to that, but I think a really key point in commercial real estate for anybody is knowing your market. And we broke Dallas and Houston up individually, and then we broke them down even further into office and industrial. And we're going to dive even deeper into submarkets that Kirsten mentioned, like the Port. But John, I want to kind of bring it back a little bit to maybe the Dallas office market. Joe mentioned some of these lenders maybe offering concessions or even tenant improvement allowances to get renters in the doors so that they can collect rent and pay their, make their covenants. Can you talk a little bit about what you're seeing maybe on the office side, and how me as a lessor can come in and negotiate a good deal so I can get into a building in regards to these allowances and concessions?
Yeah. So it's interesting. Joe mentioned this too. We do a lot of research actually on the existing debt on buildings as it pertains to finding spaces for tenants. And what that it essentially translates to on the concession side is we're seeing an uptick in free rent. We're seeing an uptick in tenant improvement allowances, and this is across the board. Where you did see that the asking rents are not necessarily going down, it's actually true that the effective rents, when you consider the concession packages that are being offered, the effective rents are actually going down, and they have been for the last 3 or 4 quarters. What we are seeing, though, is that there is kind of a limit to what the TIs have reached. Obviously, for the largest tenants and the largest spaces and the largest trophy buildings, you can see tenant improvement allowances of upwards of $100, $110 in Dallas. But for like B buildings, maybe something out in a smaller submarket, you might see tenant improvement allowances anywhere between $30 and $60. Or perhaps, maybe the landlord would be willing to offer more months of free rent in exchange for that tenant coming in.
And, again, because Texas is the greatest real estate market in the country right now, bias, of course, you're seeing a lot. I feel like I read every day in the news that a new company is moving their headquarters to Texas. How is that flight to Texas, plus a lot of businesses now moving their workers or requiring their workers to start working from the office, how's that going to change the rent market if I'm a smaller business looking for office space to rent, and maybe talk a little bit about like the central business district versus some of the submarkets that I could be looking at, and maybe things to be on the lookout for when I'm starting to try and find a space.
Sure. So at least in Dallas, I know that, and our CBD has actually just become more of the uptown focus. So I'll speak to the uptown focus. As far as uptown goes and Dallas in general goes, we're becoming more and more known as kind of a financial hub. The Y'all Street, I think, is what the Wall Street Journal just coined us as in an article like last month or so. And it's drawing in tenants like Goldman Sachs, like just across the street, they're building a huge office campus. And tenants such as Goldman Sachs and other financial services sector type employers, those businesses are way less lenient to the work from home sort of policy. Their office attendance is often 5 days a week in office. But you know what that's also bringing along with it? Those major banking tenants or investment banks with their in-office attendance. It's bringing a lot of smaller tenants that can have synergies to work together with them. And that's what's making Uptown Dallas very attractive right now for those other tenants there. You know, they don't need a 25,000 square foot floor plate or even a 50,000. They maybe need 10,000 square feet, but because they want to work together with some of these other major players in this town across the street from one another, they can set up their meetings together. It makes sense for them to be here. Similarly, up in Frisco, we've seen a large interest in the space up there, just because, well, at some point, people will choose moving further out of town to shorten their commutes. But as well, we've seen a large amount of development up that way as well.
Yeah, I feel like for the longest time, businesses chased people, and now businesses are moving to places with more affordable rent, and people are chasing businesses so that they can live a little bit closer to where they might be working. Kind of in that same vein, Kirsten, you know, again, before this, we talked a little bit about the Houston market, which I, of course, am biased to as well. Some of the submarkets, you know, some of the big demand drivers, like you mentioned, the Port of Houston. Can you talk a little bit about some of these office submarkets? And then one thing that we didn't touch on maybe in John's was some of that sublease market and where maybe these businesses can take advantage of some of these attractive sublease opportunities.
Yeah, definitely. So something that's really interesting in Houston, if anyone on the call sits in Houston, lives in Houston, you know that the CBD of Houston is more on the east side. So what we've actually seen over the last 10, 15 or so years is actually a flight to quality and a westward migration. And so what we have in Houston is a pretty prolific submarket called the Energy Corridor, and that has traditionally been home to a lot of oil and gas and oil services support companies. Where, you know, downtown, we traditionally used to have like the Shell, the Pennzoil, Chevron, Exxon. Some of those firms have since moved out of our CBD, and they've moved into periphery submarkets or even suburban submarkets. So depending on what industry you're in, kind of actually sometimes will dictate to you as a business what submarket you'd like to be in. Working at Newmark, which is a commercial real estate firm, we are located in the Uptown Galleria part of Houston. That's generally where all of the commercial real estate brokerages also office. Well, it doesn't really make sense for us to go, you know, have a office in the Energy Corridor if that's not where our competition is. That's not where a lot of our broker networking is going to be happening, that sort of thing. So to your point just a minute ago about, you know, or John's point just a minute ago about being a support business or not subsidiary, but like auxiliary type business to some of these major players, the major players sometimes definitely dictate to those second tier firms kind of where they should be. So we've definitely seen that in Houston. Something that's also interesting in Houston is this flight to quality trend that kind of permeates from certain sections of town. So we have, for instance, like Memorial City or the city center area. If you're a smaller, maybe more budget constrained firm, there are ways for you to take advantage of those amenity rich areas without naturally having to pay that premium of being in those like higher class A or class A plus spaces. And that's to find maybe like a lower class A or even like maybe B plus building that's on the periphery of those amenity rich areas so that your workers and employees can still take advantage of those things on their way into work, like CT was mentioning, with the technology. Maybe on the way home from work they want to hit the gym, they need to hit the grocery store, there's a Costco nearby. So depending on what industry you're in and where your workers need to be, based on your monetary budget, you might be able to take advantage of some of that without having to really strain your purse strings. And then real quick, did you asked about the sublease?
Yeah, just maybe where are there sublease opportunities for some of these businesses to take advantage of?
Yeah, so sublease space kind of exists across the specifically Houston office market. You can find great quality sublease space pretty much across the market, regardless of submarket specifically. But there's a lot of sublease space that's on the market that's from either Class A or A plus or Class A buildings and or tenants that during the years following the pandemic here, a lot of firms weren't really sure if they wanted to downsize. They didn't really want to make some of those really big decisions, but they knew that they didn't actually need that space because of work from home policies or more remote policies and things like that. And then also just because rents are getting more expensive, why would you want to keep paying for something that you're not necessarily utilizing? So if you're a smaller, more budget constrained firm, look into sublease space maybe in a slightly higher quality building than what you might be used to. You can maybe get on the ground floor of that, and then when that sublease term is up, you're already in. You've maybe got a relationship in with property management, with the landlord. So your team is already used to being in that facility. It's you're used to those amenities. You might be able to get some good deals going with landlords because you're already there. So that's one way. You could also opt for Class B spaces with acceptable quality or recent renovations. That's another thing we're seeing in Houston. It's kind of a flight to quality trend. If you think about it, it's kind of like a domino effect. So as more, like say, Class A tenants move up to that Class A plus space, that frees up Class A space. So then you got the B plus tenants that maybe can move, and so you kind of see these shifting bars, which is kind of what I was trying to illustrate in that slide within the presentation deck for Houston CBD. So, if you're typically in a Class B plus building, maybe you want to move up to an A minus building, there's wiggle room there. And again, it depends on your industry as a business and what image you're trying to project to your clients or your customer base as well. So,
absolutely. No, thank you. I think we've set a record for commercial real estate webinar this year, being that we're in 50 minutes and we haven't said the word data center. So I want to maybe bring it to the industrial market with maybe the last 10 minutes that we have. And John, if you want to start in Dallas, and then Kirsten will move to you kind of last on the Houston, and then Ching-Tang, I definitely want to make sure we leave people with some food for thought as we look in the future. But John, what's happening in this Dallas industrial market? Every other day, I'm reading an article about a data center being built. And something we talked about, Ting, which I want you to touch on too later, is there is this vicious cycle happening of people thinking that we are overbuilding industrial and then not building, and then we're going to be behind. So John, tell me about data centers first.
Sure. And you're on the right track there. I started really paying attention to data center activity in the Dallas market probably back in early spring of this year. And like you, I started seeing articles come out every other day, every week. There's a lot of investment activity going on. Newmark just closed a fairly large deal on the lending side. Joe, correct me if I'm wrong, as far as data center investments in Texas. So it's a little bit of a double-edged sword. A lot of people are suggesting, hey, why don't we just take these existing brand new empty warehouses and just retrofit them to become data centers, and it's not that easy. They need to be directly plugged into a power source. The needs of a data center are far different as far as water usage and power usage than a traditional industrial space. And you really need to treat it almost as a completely new and different asset class as a result. That being said, data center investment activity is on the rise here. And barring any water or power constraints, and as you know, Texas is a wonderful place to be when we have our brownouts and blackouts either in the middle of the summer or in the middle of the winter. So assuming that we can kind of overcome this power obstacle or this hurdle, data center activity is kind of poised to succeed here because, well, one thing in Texas we have is plenty of land. And as long as we can plug it in, and there's been suggestions of using a lot of excess land for solar power. And of course, what with Tesla or Elon's companies being down in Austin and expanding throughout the state, we should only see further and further investment. So I don't know if that kind of answers your question, but in a nutshell, it's happening, and it's going to happen here because we have something that many other markets do not have, which is space to build and grow.
Yeah, I mean, I felt an obligation to say the word data center in a commercial real estate presentation, so thanks for humoring me.
One thing I should add, though,
Yeah.
data centers don't bring a lot of jobs. So you say maybe for a 500,000 square foot data center, you might only get 200 jobs max out of that. So data center employment is not something that I would count on to be an industry driver. It's the development of them and of course all of the resources that they require that are really more key than an economic driver as far as employment.
Just
Joe,
to really layer on what John's saying there. I've talked to our data center brokers, and they say it's specialized labor, and they're more looking for specific labor pools than it's really driving extra employment. Labor is a factor when they look around, and Texas is absolutely come up. If not first, it is among the top two, frankly, for data center growth. But it's not going to be. It's not a couple thousand people. It's 200 people, and they have to have the right set of skills. Is what they're looking for.
Gotcha. And again, I can think about how with the kind of trying to tie this in, maybe Joe, on the capital markets side and the replacement cost piece of this is, as more data centers are being built, more lenders are going to want to lend on it, but do they have enough to lend on their balance sheet to take advantage of this? So where can, kind of private placement debt play a role? And then what is this land grab for data centers going to do to other builders trying to build out the industrial space?
I'll let for Texas. The one thing I will say is the nice thing about data centers is the actual constraint is for where they can build is labor. They don't need to build downtown, right? It doesn't have to be necessarily that close to population centers to be as benefit. Like, a classic logistics building, the closer you are to a population center, the more valuable that can be. It's not necessarily true with data centers. And so West Texas is brought up a lot as a place. It's West Texas, frankly, and North Dakota are the two places that I hear. The last time, before data center boom, the last time I talked about North Dakota as a very interesting, or West Texas, frankly, like out in boonies, is it's been a minute. So those places are where they're seeing a lot of like the land grabs. It should be interesting, and CT, you can tell me, you can speak more to this. When we think about cross-border flows and how that interrupts industrial development for capturing kind of that cross-border flow of goods from Mexico, but from serving Dallas and Houston, I'm less concerned about that.
Yeah, I would say I think Joe, very timely on that, because I was just in a client meeting this morning, and there's a lot of interest in development in Texas because of that Mexican, that border with Mexico and that cross-border sort of trade that we have. A lot of companies that we're seeing are potentially companies that have, space out in Asia that they're shipping things towards Mexico before they reroute it back over the border to Texas. And Laredo on the border is actually one of the largest freight value ports that we have here in Texas, but not only Texas, but it's number one across the US. So with that said, that I-35 corridor is paramount with the goods transferring in from Laredo to Austin to all the way up to Dallas and then further north up to Minnesota. So there's definitely a lot of activity on that front. But going back to the data center front, there's a lot of data center land grabs in the southern part of Dallas because of course, being on I-35. One trend that we've seen recently is that historically, since like say 2022, when we looked at top leases being signed, a lot of these top leases tend to be 3PL companies. And the shift has happened in Q3 of this year, where the largest lease signed was by Google for 1.1 million square feet. They also signed a 1 million square foot warehouse deal last quarter, both all in this year. And why did they sign these leases? They're signing these leases to occupy warehouse space to house their data center materials to build out their data center hubs. So there's definitely a lot of connections here between industrial data centers and warehousing.
Yeah.
It's,
Let's say before we move on from this data center topic, that's actually really interesting as well, because in Houston, as I mentioned in the presentation, we had a really large industrial sublease come off the market. It was originally intended as a build-to-suit for Wayfair, and the tenant that took it over as a sublease was Integra Mission Critical, and what they do is they're a supplier of data center materials. They make data center supplies, I guess. And so that, while not a data center itself, indicates the strength of data center emergence in Houston. And then also towards the end of October, there was in the Houston Business Journal an article about the next generation of data centers. How are we going to power them? That's really been a big story throughout not just Houston, but throughout Texas in general with our energy grid. How are we going to be powering these data centers? And Houston's positioning as part of the energy capital of the world is really great, because apparently one of the new sources of fuel for these is potentially going to be natural gas. So when you kind of couple the idea of Texas having the land, we also have the energy industry that can maybe facilitate the energy source for the data centers, it becomes a really interesting story.
No, I had to mention data centers. I'm glad we got it in. We're coming up on time, so I want to make sure that we hit any questions. I didn't see any in the chat, so if anybody has questions, please drop them here. Well, I'm not seeing any. And Darla there with LGT, stop me if I'm wrong, but I think with that at time, just want to say thanks to the Newmark team for coming on today. Again, I've had a great time having these discussions. I would say to anybody on the call today, please grab their contact information, follow up with LGT about getting connected. We're both resources for you as you go into 25, looking to make some of those decisions. And as Ching Ting mentioned, there's a lot of new tools out there to help you make the best and most informed decision for your business moving forward. So with that, again, thanks to the Newmark team, and I think we'll wrap it up from there.